Videndum shares slumped as much as 42.5% today, dropping to 265 pence and marking the lowest level since the company listed. The Imaging and Content Creation Technology Group issued a profit warning this morning, cutting its full-year guidance and naming a new chief executive in the same statement. That combination, a lower forecast landing alongside a leadership change, is what triggered the sell-off. But the same statement that crashed the stock also says the operational cause behind it is already fixed. Videndum points to production challenges at its Feltry facility, plus Middle East conflict disruption raising freight costs and delaying customer orders as the source of the shortfall. Crucially, the company states most of those Feltry issues have now been resolved, and it still expects like-for-like revenue for the first half to come in broadly unchanged from a year earlier. A stock priced for structural decline is sitting next to a management claim that the structural problem has already passed. That gap is the question this crash leaves open. If the disruption is genuinely behind the company, a 35 to 42.5% collapse in the shares may be repricing a risk that no longer applies at full weight. If the disruption is not really over, or if the guidance cut signals something deeper than a one-off logistics hit, the crash is simply the market catching up to a weaker business. The specifics matter here. Videndum now expects full-year adjusted EBITDA of between £15 million and £18 million, a significant reduction from its prior outlook. Net debt stands at £39 million, including £24 million of finance leases, a level that is manageable but leaves little room for a second shortfall. That is the contrast worth sitting with. For the 6 months to the end of June, like-for-like revenue is expected to be roughly flat against last year, with adjusted EBITDA modestly ahead over that period. The full-year cut is therefore not about lost sales, it is about cost, timing, and delayed purchasing pushed into the second half. Freight costs rose, delivery times lengthened, and customers slowed their buying decisions while the Feltry disruption played out, which pulled profit out of the year without pulling out the underlying demand. That reframes the crash. A market reading this purely as demand destruction would justify a record low valuation. A market reading it as delayed, resolved cost disruption is pricing a temporary hit as if it were permanent. The size of the share reaction, more than double the scale of the guidance cut in percentage terms, suggests the market has leaned toward the harsher of the two readings. Alongside the trading update, Videndum named John Peter Tiwes as its new group chief executive, effective from the 17th of August. Tiwes previously led Ideal Standard and worked at Villeroy and Boch on that company's integration of Ideal Standard following its acquisition, giving him a background in operational turnarounds rather than in imaging or content creation technology specifically. That is the added layer of uncertainty for holders and watchers alike. The incoming chief executive has no direct history in Videndum's specific market and takes over just as the company asks investors to trust a freshly cut, unproven guidance range. A leadership change layered onto a profit warning removes the one thing that might otherwise anchor confidence: continuity from the person who set the prior targets. That splits the outcome into two checkable paths rather than one verdict. If second-half trading confirms the guided £15 to £18 million EBITDA range once Tiwes is in place, the record-low crash becomes the entry point priced on since-resolved disruption. If Tiwes instead revises guidance downward again after taking over, that would confirm the market's harsher reading and turn the current level into a value trap rather than a bottom. Holders and watchers should treat the next trading update under the new chief executive, not today's share price, as the point that resolves which path this becomes.